Welcome to another unit in this course on economics, where this time I want to say a few words on quantitative easing as a tool of monetary policy. Quantitative easing, what is this? Well, quantitative easing means the central bank performs open market policy. So it becomes active in context of its open market policy, meaning it buys either private bonds or government debt bonds. In this way, it can increase the money supply. Well, the increase in money supply could, for example, be used to increase inflation, or put it more positively, to battle deflation. And that's also one of the effects. We can increase the money supply relatively easily to, for example, counter deflation. And that's the important effect, we can perform monetary policy without use of the interest rate mechanism. So the interest rate will not be affected, meaning we won't have any effects on, for example, investment or savings behavior, because the interest rate is not impacted directly when we perform quantitative easing. Not directly, it might change as well due to an increase in the money supply, but the policy itself does not work via the interest rate mechanism. And well, here it's nicely put as it can counter a deflation, but it's also an interesting tool on the one hand of the central bank to actively impact economic policy, because it can be used to either boost specific sectors in our economy via the purchase of private bonds, or it can be used to finance government policy by buying corresponding government debt obligations. And that's actually the critical point, because in this context the central bank directly impacts the economic development, directly has an impact on government policy, or is linked to government policy. That's one downside. The other downside, there's an increase in the money supply. An increase in the money supply means potential inflation, which also is a positive effect regarding government policy, because even if the government goes into debt, the value of the government debt will decrease. That's actually a downside of inflation in general. The debtor is always better off. So in this case, the government will be better off, and the central bank is actively helping the government by, on the one hand, making money available to it, on the other hand, alleviating the debt burden from the government. And well, that's then already everything there is to mention regarding quantitative easing as, well, let's call it a policy tool, let's call it a strategy of the central bank. Well, this concludes the session, so I say goodbye and see you next time.